You know, in trading, we're all obsessed with one thing: price, right? Getting that perfect entry, nailing the exit. But what if we've been looking at the wrong thing this whole time? Today, we're going to dig into a really powerful idea that just flips that whole script, arguing that when you trade is way more important than at what price.
So let's just start with a really provocative question here. What if this whole chase for the perfect price is just a lie, a distraction? What if the real key to consistent profit isn't found on the vertical axis of your chart, but on the horizontal one?
To see what I mean, check out this paradox. You've got two traders, Ibrahim and Shaksruk. They're both trading Euro USD, and they both get in at the exact same price, 1.05625. But here's the crazy part. Ibrahim gets smoked for a 1,000 pip loss, while Shaksruk, who got in at a different time, banks 1,000 pips. How on earth is that possible if the price was identical?
Well, it all comes down to that one single variable. The thing that decided whether they won or lost wasn't the price. That was the same for both. The crucial difference was when they decided to click the button. One moment in time made that price a total loser. Another moment made it a huge winner. And that right there reveals the secret. When you get the time right, the right price just kind of shows up.
So to really get this, we basically have to learn a whole new language. The secret language of time in the markets. And don't worry, it's made up of just a few core ideas that once you get them, will completely change how you see your charts forever.
Okay, let's start with something we all know, the candle. We all see open, high, low, and close as price points. But from this second forward, I want you to think of them as time-based events. The time a candle opens, the time of day it puts in its high or its low, these are not random. They are critical clues in this time puzzle.
Next up, we have what are called data ranges. Now think of these as specific, predictable windows of time, like say, the first couple hours of the London session, where the market is statistically very likely to pull back or even reverse. Now why does this matter? Well, because knowing when a move is likely to happen lets you get in position to target those big pools of liquidity with some serious precision.
And if we zoom out even further, we get to time cycles. This is the macro view, the big picture. For example, there's this concept called the quarterly theory, which suggests that the institutional smart money engineers market trends over these 3-month cycles. They're often creating huge turning points right at the start of a new quarter. See, these aren't random market swings. They're part of a bigger, repeating, time-based schedule.
So why should you make this big mental shift? Well, honestly, the logic is just undeniable. First off, the smart money, the institutions that actually move the market, they operate on a time-based schedule. And hey, think about it. Every single entry pattern you use, whether it's a breakout or a reversal, it's defined by when it happens. Trying to trade without understanding this stuff is like flying blind. Mastering time isn't just a nice little add-on. It's the bridge that takes you from gambler's luck to being a consistently profitable pro.
Okay, so the theory sounds great, but how do we actually make this practical? You know, how do you turn all this knowledge into a real, actionable edge? Well, that's what we're going to cover right now. Building your own time-based trading model.
Building a model that you can actually trust is a 2-step process. Phase 1 is all about data collection. And I gotta be honest, this is where most traders just give up. You need to pick one specific time-based idea, like how does the Wednesday candle behave every single week, and backtest it. And I don't mean for a few months. I'm talking at least 1 year, and ideally 5 to 10 years of data. Once you've proven you have a real statistical edge, then you move to phase 2, forward testing it in the live market for 3 to 6 months to make sure it really works.
And this brings us to a huge truth about trading psychology. You know that awful feeling of FOMO, the fear of missing out? It's not just some random emotion you need to control. No, it's a direct symptom of being unprepared. It's what your brain does when you haven't done enough backtesting to truly believe, deep down, that another perfect opportunity is scheduled to arrive very, very soon.
Now, to make this really concrete, let's break down a specific time-based model from the source material. It's called the Wednesday model, and it's a perfect example of how all these principles actually work in the real world.
Let's kick this off with a pretty foundational statistic. Based on historical data, there is a 70% probability that the absolute high or the absolute low for the entire week is put in by the end of Tuesday. Just let that sink in for a second. Most of the time, the weekly extreme happens in the first 48 hours. That insight alone is a total game changer.
But wait, we can get even more specific. The data shows an 81% probability that the week's high or low forms inside a very tight window.
between the Sunday Open and the end of the London session on Tuesday. This isn't just a small edge, people. This is a massive statistical advantage that tells you exactly when you need to be paying maximum attention.
So how do you actually trade this? Well, first, you figure out your higher time frame bias. Are you bullish or bearish on the big picture? Second, you mark the midnight opening price in New York. Simple. Third, you identify some key price levels above or below that open. Then you just wait for your favorite entry pattern to show up in relation to that opening price in line with your bias. And finally, and this is so important, you record everything. Win, lose, didn't take the trade, write it all down and analyze it.
You know, when you really start to integrate this time-based approach into your trading, it does way more than just change your strategy. It fundamentally transforms your entire mindset as a trader.
Remember that FOMO we were just talking about? It just starts to disappear. And why is that? Because you finally understand that opportunities are not random, once-in-a-lifetime events. They are cyclical, they are predictable, and they are based on time.
This all leads to this incredibly powerful mindset shift, and it's best described with this analogy. When you have a time-based model that you truly trust, you stop chasing the market. You start waiting for your setups like you're waiting for a bus. If you miss one, you don't panic and sprint down the street after it. You just wait calmly, because you know for a fact another one is scheduled to arrive really soon.
And this is the core belief that lets you be that patient. Every single day, at midnight New York time, the clock resets. A brand new daily candle is born, and with it comes a fresh set of predictable, time-based opportunities. The market literally gives you a clean slate every 24 hours.
So here's the bottom line. The market operates on a schedule, just like a bus system. Those high-probability opportunities are going to keep arriving at predictable times. The only question left is, have you done the work to learn the timetable? Are you going to be ready at the stop when your bus arrives?